This is the first video in a series of 4 videos on corporate governance. And this first video deals with corporate governance and corporate organizations. Before we delve into the remaining part of this video and the subsequent videos, it's probably a good idea that we take a few minutes and define what governance really means. Governance is a combination of people, policies, procedures, and processes. It ensures that an entity effectively and efficiently directs its activities towards meeting the objectives of its stakeholders. Now, notice I use the word stakeholders. Most people would expect me to use the word shareholders. In other words, the owners of the company. The truth of the matter is, though, that the shareholders are only one component of a group of people who are dependent upon the operation of the company, and we call these stakeholders. Now, if we define stakeholders, then stakeholders are persons or an entity other than the entity who are affected by the activities of the entity. Examples are obviously shareholders, the employees of the entity, suppliers and customers of the entity, and the government, who may rely upon the entity for goods or services or may rely upon the entity for tax revenues. And there can be many other additional stakeholders beyond that. Now, we need to understand that corporate governance emanates from two sources. One's from an internal source. Internally, that emanates from corporate charters, corporate bylaws, and boards of directors, and then from that, then the executive officers of the company and the employees of the company. It also emanates externally through either federal or state legislation. We're going to be dealing pretty much with federal legislation, and that's going to include the Securities Act of 1933, the Securities Exchange Act of 1934, the Sarbanes-Oxley Act, or SOX Act of 2002, the Dodd-Frank Act, and last but not least, the FCPA, or the Foreign Corrupt Practices Act. This legislation provides governance requirements to corporate activities. Now, let's go ahead and take a look very briefly on how a corporation is formed. In terms of initial corporate documents, the first thing is that corporations are normally formed under state laws. There's very few situations where a corporation is incorporated under federal laws. Typically what happens is that a group of investors get together and they file articles of incorporation. Those are filed typically with the Secretary of State in which the corporation, in which state the corporation is actually being formed. And generally speaking, the articles of incorporation include the corporation's name, the number of authorized shares of stock. In other words, you have to put down the number of shares of stock that are authorized, because you just can't keep magically creating shares of stock. The address of the corporation's registered office, and the name of the corporate registered agent, in other words, where people can contact the corporation, and the name and address of each incorporator. And there's other various pieces of information that have to be provided based upon the individual state. Now, along with the corporation, the company, the incorporators are going to also file bylaws. And these generally contain any provision for managing the corporate business. And these typically include the authority of officers and the directors of the corporation. Number two, the method of selection of the directors and possibly the officers. The terms of directors and again, possibly the officers. The compensation associated with the directors. The procedure for issuing new stock, and then there's other miscellaneous items that are also included as part of the bylaws. Take a look at the fundamental body for corporate governance, and that's the board of directors. If we take a look, most boards of directors have a series of duties, and here I've listed the common duties of the board of directors. This includes the hiring, removing, and the compensation of corporate officers. Typically, the board of directors hires the CEO of the company. Then it's typically up to the CEO to hire the other corporate officers and then compensate them in line with the requirements of the board of directors. The board of directors meet on a periodic basis, and that's at least quarterly, to provide strategic oversight. And strategic oversight includes things like how the capital structure should look in the company, debt versus equity. Uh, Also, to provide strategic oversight on mergers, acquisitions, dissolutions, or sales of different divisions of the company, declaring dividends, and other type of strategic type of activities. Now, the normal operating activities of the corporation is typically overseen by the corporate officers. The board of directors does the strategic governance. Okay, the board of directors also may make changes to the bylaws of the corporation unless this authority is granted exclusively to the shareholders, or that authority must be approved by the shareholders. Also, the board of directors is also responsible for the oversight of external audit services, the public accountants, and internal audit services. So the board of directors is responsible for monitoring the internal controls and financial reporting over the company. Now, the board of directors act as a fiduciary, and if we want to, first of all, if I can pronounce it, that would be good. But in terms of fiduciary, uh, the term basically means that individual has a legal duty to act for the benefit of the corporation. So that person has a responsibility or the legal duty to act for the benefit of the corporation. And some of these responsibilities are to act in the corporation's best interest, used due diligence in carrying out responsibilities. There's an obligation to disclose a conflict of interest if there's a conflict of interest that does conflict with the interest of the corporation. Also in line with this, in the event a business opportunity presents itself to a director, the director must give the corporation the first right of refusal of that opportunity if that opportunity is in alignment with the corporation's interests or operations. Also, directors can be held financially, personally responsible for the acts of the corporation. However, a director is exempted from personal liability if the director has acted in good faith, was not motivated by fraud or conflict of interest, and was not grossly negligent. Now, as I previously mentioned, the board of directors hires the officers of the corporation, or the board of directors at least hires a CEO, then the CEO would hire the rest of the officers of the corporation. Now let's take a look at the characteristics of the officers of a corporation. Typically, the chief executive officer, the CEO, is normally hired by the board of directors, as I'd mentioned before, and then the CEO selects the other C-level executives. The officers of the corporation are responsible for the company's daily operations. Also, officers are defined as agents of the corporation, and therefore those officers can enter legally binding contracts on behalf of the corporation. Now let's talk about the shareholders of the corporation. And again, remember that shareholders are only one category of stakeholders in a corporation. Let's talk about the common rights of common shareholders in a corporation. First of all, common shareholders are those shareholders who have contributed the primary capital to the corporation. They have the right to participate in earnings equal to the share of their ownership in the event the board of directors declares a dividend. The common shareholders have a right to participate in the event that the corporation is dissolved. They have the right to participate in their proportionate interest in the assets of the corporation. They have the right to vote in selecting or removing members of the board of directors. They also have the right to vote in any other matters as designated by the bylaws of the corporation. And common shareholders have a limited liability. That means their liability is limited to the amount of their capital investment in the corporation itself. Now there's another category of shareholders, and they're typically called preferred shareholders. They have most of the same rights as the common shareholders. However, typically they do not have voting rights as do the common shareholders. But they do have the right to receive dividends before common shareholders in the event that there's not enough dividends declared to cover the common shareholders. So that's the end of our presentation on corporate governance organization part 1. So when you're ready, go ahead to corporate governance part 2.